Hello traders, welcome to another episode of our training session. This is Leading Forex YouTube channel, and on this channel we serve you with free Forex training, and all the videos that we do here are to help you, aid you in your journey to become a good Forex trader. My name is Kofi, your admin for this channel. Once again, I welcome all the subscribers. God bless you for subscribing to this channel. We have a lot of things that is coming your way, and so please stick and stay. Hit the notification bell so that any new video that will be dropped on this channel, you will be the first to have access to it. So in today's video, we're going to talk about a very important topic in the Forex market, and that is intermarket correlations. Intermarket correlations. Now, what do we mean by intermarket? Intermarket simply means that there are a lot of markets when it comes to the online money-making world. We have a lot of markets. We have the futures, we have the commodities, we have the Forex, we have the cryptocurrencies, a lot of these markets. We have the stock market and the rest. So these are different markets. And we are saying that some of these markets correlate with others, or some decisions that happen in other markets reflect on other markets, or they actually create a decision for the other markets. So that is what this whole intermarket correlation topic is going to be about. And I can tell you that we can't finish all these in just this video. When it comes to intermarket correlations, there are a lot of topics, and we cannot just finish that in just this video. So this is going to be a series of videos that will come your way. So this is still the way to get in touch with me. If you want to contact me, my Telegram channel or my Telegram link is at Kofi Dollar. That is my handle on Telegram. You can send me a message on Telegram, and then we can vibe. My email is leadingforexgh@gmail.com. Let me take that again, leadingforexgh@gmail.com. And then via phone, +233 246 136609. The same on WhatsApp, +233 246 136609. The +233 is my country code, that is Ghana. So once you send me a message, we can get in touch with each other and vibe along. Is that okay? Now, Leading Forex, we want to be an alternative in whichever status quo you are stuck in, be it the cryptocurrency world, the stock market, the Forex trading world, the commodity, the future world, wherever that you are stuck in, that you need a way out. We want to provide you that way so that you can become successful by getting out of wherever you are stuck. So Leading Forex, that is what we stand for. So this community is to help every trader, whether commodity, Forex, crypto, whatsoever market. We are here to provide you with an alternative. Is that okay? So quickly, let's go to the intermarket correlations. Now, when it comes to the intermarket correlations, we're going to talk about a lot of markets. The very first one we'll be looking at is the US dollar index. The US dollar index. We will also be looking at gold. We will be looking at oil. We will be looking at stocks. We will also be looking at the Euro JPY as a currency pair. Sometimes when you see this currency pair, it has some effect on other markets. So we will be looking at that. We will also be looking at some bonds, the Euro bonds and other bonds. And then so many other markets that we believe have a correlation in other markets. Is that okay? So we have a lot, like I said. We may not be able to do all of this in just one video. So today we're going to talk about only the US dollar index, the US dollar index. I'm sure you might have heard of it. And so there's a need for us to talk about it in this video. So when we say the US dollar index, what do we mean? Now, the symbol for the US dollar index is boldly written here. These are the three symbols that you may see depending on what kind of platform you are using or broker you are using. You may see the USDX, or you may just see the DX, or you may also see the DXY. Any of these, we're talking about the US dollar index. Is that okay? But sometimes, okay, later on we'll look at the DX and the DXY, what they really stand for. But in all, some brokers choose to use USDX, some choose to use the DX, others choose to use the DXY. But they all have a meaning, and we'll be looking at that as we move along, okay? So any of these symbols that you will see, depending on your broker, some too, you may not even see any of this. You just see the dollar. You just see dollar rating. You just see dollar. They will just write dollar. So when you see dollar, they are trying to tell you that it is the US dollar index, okay? So let me make it 4. So whether you see USDX, DX, DXY, or dollar, any of these is talking about the US dollar index. Are we good? Okay, let's continue. Now, what is the US dollar index? The US dollar index is the weight of a group of securities. And when we say securities, we are talking about a group of currencies measured against the US dollar. So in real time, we have the dollar here, USD here on one side, and then we have another set of currencies that are in a group. And then all these group of currencies are combined, and their weight, their volume, their strength is measured against the US dollar. So here we have, for instance, 10 people against 1 person. So we are measuring the strength of 10 people as against the strength of 1. Are you getting the scenario here? So the US dollar index is a group of currencies that is measured against the dollar as a standing currency on its own, or as a loan currency. So what are some of the currencies that are grouped and then their strength measured against the US dollar? And that will bring us to our next topic, point here. The securities, which simply means the currencies we are talking about, are some other major world currencies. And they are the euro, the Japanese yen, the British pound, Canadian dollar, Swedish krona, and then the Swiss franc. So we have 6 currencies that are measured against just the US dollar. This is serious, right? So we are combining the strength of 6 currencies, and then we match their strength against the US dollar alone. Wow. Why do they do this? And why has it come to that? That means the US dollar is such a powerful currency, right? Good. So when you hear the word, the US dollar index, we are talking about 6 major currencies grouped together and then measured against the US dollar in terms of strength. In terms of what? Strength. In terms of weight. I hope this explanation is clear. Good. Let's continue. Now, let's read some more notes, okay? Let's read some more notes and see what it is, okay? So the dollar index is made up of 6 currencies, just as I've said. Now, how many countries are included? Because I have just told you about 6 currencies. So if we have 6 currencies here, how many countries are we looking at? 6 currencies. We have the euro, Japanese yen, British pound, Canadian dollar, Swedish krone, and then Swiss franc. So how many countries are we looking at? This is the question we need to answer. Now, when we move forward, if you say that the answer is 6 countries, you are wrong. Yes. Why are you wrong? Because the euro is the official currency for 19 countries out of the 27 member states of the European Union. You know, European Union comprises of 27 countries or member states. So 27 countries form European Union. Out of these 27 countries, 19 of those countries are using the euro as an official currency. So already we have 19 countries. And then we have other countries. So 19 countries with only the euro. All right, let's continue. And then let's add the other 5 countries, which is Japan, the Great Britain, Canada, Sweden, and then Switzerland. So when we add these other 5 countries, 5 plus 19 will give us 24. So when you say the answer is 24, then you are right. So we are looking at 24 countries' currencies against just one country. Initially, we were looking at just 6 currencies, but now when we expand it to countries, we are looking at 24 countries. So 24 countries' currency is being measured against the US dollar. This is getting interesting, huh? Let's continue. Now, so it is obvious that 24 countries make up a small portion of the world, but many other currencies follow the US dollar index very closely. Yes, one may say that, okay, 24 countries being measured against just one country, which is the US. And one will say, okay, 24 countries is still something very small. Yeah, that is true. If you look at the number of countries we have in the world. But the truth of the matter is that there are other countries that follow the US dollar index closely. They monitor it. And then they are able to predict, to know where these currencies are going. I mean, the US dollar index is going. And then they use that to make decisions with regards to their country's currencies. I mean, the other countries in the world. So the US dollar index, yes, it is true that we have just 24 countries with 6 major currencies, but other countries also look up to this US dollar index. So now that we know what the basket of currencies that the dollar index is composed of, let's get back to the geometric weighted average. Because here we are saying that we have 6 major currencies being measured or weighed against just one, which is the dollar. So again, we are saying these 6 currencies have 24 countries. Or we are talking about 24 countries using 6 currencies. And it's being measured against just the dollar alone. So what will be the weight of these 6 major currencies from the 24 countries? What will be the weight? If we are looking at the weight, what will be the weight against the dollar? Is that clear? Good. Now let's look at that. Now, this is a chart giving us an estimated weight of each of the 6 currencies, which is being measured against the dollar. We have the euro, and don't forget, the euro, like we said, is used by 19 countries. So the euro has a percentage of 57.60% of the total weight. So when we take the total weight of these 6 currencies, the euro alone is having a weight of 57.60%. followed by the Japanese yen, which has a percentage of 13.60%. And also followed, the third one is GBP, followed by GBP, 11.90%, followed by CAD, 9.10%, followed by SIC, which is the crony or the krona, 4.20%, and then chef, 3.60%. So when you combine all these weights together, you get 100%. So the total weight, which is a total 100%, euro carries the majority, followed by Japanese yen, followed by the GBP, CAD, and the rest. Is that okay? So this is the weight that each of these currencies carry. And then it is measured against the US dollar. And once you hear the US dollar index, we are talking about 6 major currencies measured against the US dollar. Can we continue? Good. Now, we need to know which institution is in charge of this, or which institution is helping us with this, or which institution owns this dollar index thing. Now, we have an institution called the International or Intercontinental Change Group. Intercontinental Exchange Group, I beg your pardon. Intercontinental Exchange Group, known as ICE. They are in charge of this US dollar index. So some brokers will even use ICE US dollar index. You see that as an acronym in terms of naming of the the index. When it comes to the naming of the index, there are other brokers that will use ICE US dollar index. So when you see it, don't be surprised. The ICE that you are seeing is the company that is in charge or that owns the US dollar index. So Intercontinental Exchange Group, known as ICE, they own the US dollar index. And this Intercontinental Exchange Group, which is known as ICE, is a global exchange, clearing, financial data, and technology company operating multiple markets and services across 9 different asset classes. The ICE operates 13 regulated exchanges, including ICE features, the OTC exchanges in the US, Canada, Europe, and Singapore. It is also the parent company of the well-known New York Stock Exchange. So the well-known US Stock Exchange is owned by this company. So this is not just a mere company, it's a very big company. The ICE company is the parent company of the New York Stock Exchange, which is a very popular stock exchange market in the US, which is one of the biggest stock market exchange in the world, the US stock market. And the ICE company owns it, which is Intercontinental Exchange Group. They own the New York Stock Exchange. So if a company like this is coming out with an index known as the US dollar index, that should tell you that the credibility is there. And the way people will see it in terms of value is also there. All right. So the US dollar index is the exclusive property of the ICE, also known as the Intercontinental Exchange Group. So the US dollar index is owned by ICE. They own it. It's for them. Shall we? Good. Now, this ICE company provide data. They provide market price. They control this dollar index. Okay? The dollar index market or its price is not controlled by the banks, the big banks, the Barclays, the CHF, and then the JP Morgan. No. The dollar index price is controlled by ICE. That's Intercontinental Exchange Group. They control the price of the US dollar index. So basically, since ICE control the price data, they charge a fee for the data feed. Access to a real-time feed does not come free. So if you want to see the price quote, live feed of the US dollar index, you may have to pay a fee before the ICE company will give you access. And the good thing is that they update the price every 15 seconds. Every 15 seconds, they update the price of the US dollar index. Every 15 seconds. That is if you have subscribed or you have paid for the data. So there are institutions and countries that pay for this data because they want to monitor it in order to know how their currencies will also be faring. So there are banks and institutions and governments that actually pay for the data that is coming from ICE with regards to the US dollar index. So maybe you and I may not be able to pay. So what happens? Now, since we may not be able to pay to get the live feed or the actual price quotes, we have another option. There are delayed prices for the ICE US dollar index features, and that is available on the ICE website. The delayed version is on their website. So if you need a delayed version, you can get it on their website, and we will go there very soon and look at it. Is that okay? We will go to their website. At least we forex traders, retail forex traders may not be able to pay for the live feed. But in case you have enough money, you can pay for it. That is if only you get to know its importance and you think you need that data to be able to trade the forex market. Then of course you can pay for it. But even if you don't pay for it, there's still the delayed version that can also help you. Or there's also another way to go about this. And that is why I am doing this video. So watch this video to the end. I repeat, watch it to the end. All right. So the delayed prices for the cash US dollar index can be found on their website and other websites. So we have other websites that also give us the delayed prices or the delayed data. And some of those websites are the Bloomberg, we have the Market Watch, we have CNBC, we have the WSJ, and then Yahoo Finance. So these other websites also provide us with the delayed data that is coming from ICE, Intercontinental Exchange. What is the name? Why am I forgetting the name? Intercontinental Exchange Group, ICE. All right. So let's continue. So you can access the delayed data. But before we go to their website, let's look at how the website looks like. I mean, the delayed version. When you visit their website, now I'm going to leave the link to this website at the description of this video. When you go to the description of this video, you will find a link that will take you straight to this website, and you will see the interface like this. Okay, so this is just a recent screenshot that I took. Today is 28th of November. So I took this this screenshot today. The screenshot you are seeing is taken today, but I will still take you to the website very soon. So this is what you will see. And look at it. From now up to December 2021, this is the data currently. And then between December 2021 and March 2022, this is what they are anticipating. And then between March 2022 to June 2022, this is also what they are anticipating. Is that okay? Good. Now, if this is what it is, let's go to the real website so that we can take things further. Okay, let's go to the real website and then look at some things for ourselves. Where is the real website? Where are you? Okay, let's go to the browser and look at the site here. So this is the site. And like I said, I'm going to leave a link of this website at the description of this video. So just go there and you get access, or you have access to it. Now, when you go to the website name is theice.com, theice.com. When you go to theice.com, you go to resources. Under resources, you go to data. Under resources, as a menu here, resources, then you go to data. When you click on data, you have access to this over here. Now, we have December, before the end of December 2021, and then before March 2022, and then June 2022. Now, before December 2021, let's look at it. Let's click on that one. So, December 2021, currently, this is what it is like. This is the chart for intraday, that is on daily basis. If you go to, currently the price is sitting here at, the price is currently at 96.085. 1 is to 96.085. So the 1 stands for the US dollar. All right, 1 is to 96.085. That is currently where this price reached before Friday, the market closed. So that's for daily. If you go to 3 months, this is what you will see for 3 months. So you see that 3 months, the US dollar index has been going stronger. So it's been going up. If you go to the 1 year chart, the US dollar, in terms of the 1 year chart, January 2021, if you look at it down here, you see January 2021. So January 2021 up to where we are currently in November. In November 2021, this is where the dollar index has moved up to. So it's been going up. The US dollar index has been growing, or has been very, very strong up to this level as we speak. The same way, if you switch to the 3 months, like I showed you, from September 2021, from 6th September up to November 15th, currently this is going to be November 26th. Where we are today is November 26th, which was on Friday. This is where the price is currently. And then when you go to the intraday, from 2 a.m. on Friday up to 6 p.m., this is the data. So this one is for daily, 2 a.m. to 6 p.m. when the market closed. The 6 p.m. you are seeing here is time for US, New York. So 6 p.m. in New York is when the market closed. If you have watched the time zone video, which is the part 30, you will understand the time zone. So 6 p.m. you are seeing here is actually the time in US. So all the time you are seeing here is in US, the US time. Okay, so the time you are seeing here, if you put it on intraday, the time you are seeing here is US time, New York time, the New York time, because ICE is in US and they are in New York. All right. So this is the website. So if you click on December, which is the current one, December 2021, this is what you will see. Once we enter into January 2022, you can click on the March one and you will begin to have access to the data. And once we end March 2022, you can click on June 2022 and you have the next set of data. Is that okay? Now, this is December. Let me go back a bit and let's do something. Good. This is December 2021, and the last price is sitting at 96.085. Now they are anticipating that the US dollar has fallen a bit. Change in percentage. The change in percentage has reduced a bit, because from where it was, you realize that on Friday, the dollar index fell. If I go back, you see on Friday, the dollar index came down, it fell. So on Friday, it reduced a bit. Is that okay? And that is why you are seeing this change in percentage, negative 0.02%. It means on Friday, this dollar index reduced by this percentage. Now, they are anticipating that by March 2022, that is from January 2021 up to March 2022, the US dollar index will reduce a bit by 0.025. It will reduce a bit by 0.025. And then from June 2022 upwards, or from after March 2022, March, April, May, June, the next 3 months, the dollar index is going to increase, is going to be strong by a percentage of 0.037. This is what is going to be the increment. It's going to increase by this percentage. Now, we will come back to this and you understand why these predictions are very, very important to we, the Forex traders, because this whole dollar index is all about currencies that are being measured, the strength being measured against one particular currency known as the US dollar. So it is very, very important to us Forex traders. Okay, let's get back to the slides. So this is the website. And like I said, I'll leave the link of the website at the description of this video. Let's continue from here. Now, how to read the US dollar index? How do you read it? And that is where we are going now. Note that the index is calculated 24 hours a day and then 5 days in a week. So it ends on Friday. It is calculated 24 hours a day and then 5 days in a week. An update, it is updated every 15 seconds, just like I said previously. Also, the US dollar index, which is the USDX, measures the dollar's general value relative to a base of 100.00. So take this as 100, okay? Now we are looking at how this is calculated. Let's see this as 100 or 100%, okay? So the base is 100. The dollar is measured at a base of 100%. Okay, you understand this, don't worry. So for example, the current reading says, the one we just saw on the chart, it says on Friday, the current price of the US dollar index was 96.085. So if that is the current price of the US dollar index, this means that the dollar has fallen by 3.915% since the start of the index. Now, because the base is 100, you will subtract 96.085 from 100. So this is 100. When you subtract 96.085 from 100, you should get 3.915%. So it means that the dollar has fallen by this percentage. The dollar is measured from a base of 100. So below 100 means the dollar is weak or the dollar is falling. Above 100 means the dollar is gaining strength or is becoming very strong. Do you get the scenario? The base length or the base number for the US dollar is 100. So if it is below 100, it means the US dollar has reduced in strength. But if it is above 100, it means the US dollar is gaining strength. Please, do you get it? Good. So that is how come when we subtract the current price now, which is 96.085 from 100, we should get the 3.915%. So this is to tell us that the US dollar has fallen by 3.915. So it means that when the US dollar is 100, it means from 100 upwards, the US dollar is becoming strong. But below 100 means the US dollar is falling. Okay? And this is what most international communities look at. Before they will say the US dollar has crashed. When we say the US dollar has crashed, it means the US dollar has moved. This index has moved from 100% to 0.00000. Then we can say the US dollar market has crashed. But now that it is somewhere here, it hasn't crashed yet. The dollar is still strong, but just that it has reduced a bit by a percentage of 3.915%. Is that okay? Now, assuming if the reading was 120.650, this means that the dollar value has risen 20.65% since the start of the index. The reason we are getting the 20.65 is because when you subtract 100 from 120, you will get 20.65%. Now you understand the calculation. Good. Let's continue. Now, the start of the US dollar index is March 1973. So this US dollar index started in March 1973. This is when the world's biggest nations met in Washington, D.C. and all agreed to allow their currencies to float freely against each other. The start of the index is also known as the base period. So the base period, the dollar was at 100. And all these other currencies were grouped. And then their strength is being measured against the dollar at a base of 100. So when the dollar index goes beyond 100, it means it is increasing in strength. When it comes below 100, means it is decreasing in strength. Are we good? Let's continue. Now, how can you use this US dollar index for forex trading? How can you trade the forex market with it? Now, this is where we all need to pay attention. Maybe get a note, a book, and a pen and jot some things down. Most of the widely traded currency pairs includes the US dollar, you know that. And some of these pairs are Euro USD. So Euro is paired against the US dollar. GBP is paired against the US dollar. USD is paired with SHEV, USD with JPY, and then USD with CAD. So these major currencies have the US dollar as either a base currency or a subsidy, or maybe an opponent, or maybe there's a term I want to use. There's a forex term I want to use. Over here, the US dollar is a base currency. Okay. Here, it is not a base currency. Over here, the euro is the base currency. All right. Good. I'll get to that way as we move on now. So the simple term I want to say is that the US dollar is paired against certain currencies. And the fact that the US dollar is paired against certain currencies means a lot to us as forex traders. So when the market outlook for the US dollar is unclear, when the market outlook for the US dollar is unclear, more often times than not, the US dollar index provides a better picture. So when people want to trade these currencies that have the US dollar and they do not see a clear picture of the dollar, whether the dollar is going to be weak or strong, people tend to go and look at the US dollar index. And they use that to predict the strength of the US dollar. So in the world of forex, the US dollar index can be used as an indicator for the US dollar strength. So if you want to know the US dollar strength, you can use the US dollar index to determine the strength of the US dollar against other currency pairs. So how do we do that? This is where we'll get to the practical session quick. Now, because the US dollar is comprised of more than 50% of the euro, which is the Eurozone, don't forget, the euro alone is carrying about 19 countries. So because the US dollar index comprises about the greater portion, which is about 50% of the US dollar index, in most times is the opposite to the US dollar index. Now, you soon understand what I mean by this point here. What we are trying to say is that because the US dollar index has a greater portion of the euro, when it comes to a currency pair like Euro USD, when it comes to this pair, Euro USD, when Euro USD is going up, you will see the US dollar index going down. And when the Euro USD is going down, you will see the US dollar index going up. So the US dollar, Euro USD is always in opposite direction of the US dollar index. We will soon go to the chart and look at this. So this is how we are beginning to look at how we can use the US dollar index to trade the forex market. And we are saying that because the euro has a greater portion in the US dollar index, whenever the index is falling, Euro USD becomes stronger. And whenever the index is rising, the US dollar falls. So when the US dollar index is rising, it means it's becoming stronger. It means the 6 major currency pairs that are being measured against the dollar is becoming weak. That is why the index is going up. Please do get a scenario. We are measuring 6 currencies against 1. So when you see the index going up, increasing in terms of number, that should tell you that the dollar is outweighing the 6 currencies here. It means these 6 currencies are becoming weak against the dollar. That is why the US dollar index is going up. But when you see the US dollar index going down, it means that the 6 currencies are becoming stronger than the US dollar. That is why they are pulling the US dollar down. So I want you to see the US dollar index as USD. Take it that the US dollar index is the currency USD. In simple terms, the US dollar index is for USD. So whenever you see the US dollar index going up, it means USD is also going up. In that case, it means these currencies are getting weak. That is why the dollar is going up or the index is going up. But when you begin to see the US dollar index falling, it means these currencies are becoming powerful than the US dollar index, which is the USD. That is why the dollar index is falling. I don't know if you get this, but I pray that you understand. Now let's go to the chart and look at clear practical examples. With what we've just said, let's go to the chart, the MT4. Now, this is the MT4. This is the US dollar index. When you go to your currencies, you see the dollar. My broker, the name is just dollar. So dollar, when you pay dollar, this is the US dollar index, dollar. So you see it, dollar index features. So this is the dollar index over here. So when the US dollar index is going up, now as we can all see, the US dollar index has been going up. And the rule is that when the US dollar index is going up, a currency pair like Euro USD will be going down. So let's bring Euro USD and see something. Euro USD. Where are you? Euro USD. See how down it has been going. So it means the US dollar index is in opposite direction of the euro. So US dollar, this is Euro USD going down. And then look at how the dollar index is going up. Look at the dollar index here. Let me flip to the dollar index. This is the dollar index going up. Euro USD going down. So this is the correlation. So when we come to currency correlations, this is what we mean. So here the US dollar index is going up. This is on daily time frame, please. This is on daily time frame for both the dollar index and then the Euro USD. So Euro USD is going down. The dollar index is going up. Euro USD is going down, downtrend. The dollar index is going uptrend. Do you see the scenario? Now, I want you to look at Friday, what happened in the market. And then you actually understand the reversals that we are, or the correlation that we are talking about. This is US dollar index. On Friday, look at what happened. The dollar index fell, right? The dollar index fell on Friday. Let's go and look at Euro USD. What happened on Friday? This is what happened on Friday. On Friday, Euro USD rose up. Look at it. So you see how opposite they go. You see how opposite they go. So the Euro USD on Friday went all the way up, whilst the dollar index came down. So you see it? It came down. Now, it is not only this currency. This is still euro, this is still dollar index, okay? Don't forget that the dollar index comprises 6 other currencies that are measured against it. So we have the euro, we have the JPY. So let's look at USD JPY. This is the dollar index against USD JPY. So let's move away from euro USD and pick USD JPY. Where is USD JPY? USD JPY. Look at it here. Look at what happened on Friday. USD JPY, what happened? JPY is the base. So it means USD JPY. So the dollar became weak on Friday, isn't it? This is the dollar on Friday. The dollar became weak on Friday. And USD JPY also took USD down on Friday. Look at it. Just look at it. So you see how the US dollar index correlates with the currency pairs. So on Friday, USD fell. When you go to the dollar index, this is the dollar index is termed as dollar. So the dollar fell on Friday. This is the US dollar index. And it happened here. JPY took the USD down. How many pips on Friday alone? On Friday alone, it came down as 225 pips. 225 pips on only Friday. Now, let's look at another pair. We have the chef, right? Chef is also a correlation. Let's bring chef here. Look at chef. So on Friday, USD chef, CHF. USD CHF. So it means the CHF, if the dollar fell on Friday, it means CHF must be strong to take the dollar down. And look at it. USD CHF. This is it on daily time frame on Friday. It took the dollar down. This is the correlation. This is the correlation. When it comes to the US dollar index with the major currencies or the pairs, there's always that correlation. So if you're a Forex trader and you trade currencies, the dollar index must be an important tool to watch. If you would trade any pair that involves the USD as a currency, you always need to watch the dollar index also. It is very, very important. So the advice I have for you is this. Does this happen across all the pairs that has the USD? I will advise and say that no. This only happens, the correlation only happens on the currency pairs, sorry, the currencies that have major weight. I'm talking about the 6 currency pairs that have the major weight. And always I look at Euro. The correlation often happens on Euro, Euro USD, USD JPY, sorry, USD, sorry, USD JPY, Euro USD, and then Chef JPY. Sorry, did I say Chef JPY? Come on. And the USD Chef, I mean. USD Chef. These 3 currency pairs. If you want to be looking at the correlation, and then maybe USD SEK. USD SEK. SEK. These are the 4 main currency pairs I will always ask you to look for in terms of correlation. The rest, leave it. And I'm quickly going to explain why I'm saying the rest, leave it. For instance, GBP USD. You will ask that, what of GBP USD? Look at GBP USD. On Friday, the dollar fell, isn't it? The dollar fell on Friday. Let's look at USD, GBP USD. Look at it. On Friday, this is what happened. So you see that that impact wasn't felt. This is USD JPY. Sorry, GBP USD, GBP USD. Look at what happened on Friday. And then maybe USD CAD. I think USD CAD is also there. USD CAD. Where is USD CAD? USD CAD is here. Look at USD CAD. Even USD CAD on that day, USD even became stronger. Whilst USD index was falling, USD was still even going stronger against Canadian dollar. So you see, but if you don't want to be an inter-trader and you want to be a general trend trader, then that will be your own thing to look at. But like I said, you see that this one, it is not actually giving you direct interpretation. So that is why I am saying that when it comes to the dollar index, you leave USD CAD out, leave GBP USD out. Maybe let's see AUD USD too. I think it's also some way somehow. Yes, yes, USD AUD to leave it out. Leave that one too out. So leave this one too out. All right. So these are the currencies that I would suggest you leave them out when you are looking at the correlation. You should only target Euro USD and then USD Chef, USD JPY, and then maybe USD SEK, that's SEK. The rest, leave them. So if you want to use the US dollar index to trade, then this is what you need to be looking out for or watching. Are we good? Now, let's go back and finish our discussion. Let me go back to the slides. Then we can finish whatever we have today. So finally, what I will say is that to sum it all up, Forex traders use the USDX, which is the US dollar index, as a key indicator for the direction of the US dollar. This is to sum it all up. This is what I would say. It's just an indicator for the dollar. And if you are to use it, I have told you the currency pairs you should be watching, especially The favorite one, if you are to use the US dollar index, will be Euro USD. It will be a favorite pair to use. Euro USD will be a favorite pair to match with the US dollar index. So if you want to use the index, a favorite pair you can use that is with Euro USD. All right. Now, if you have any questions, you can leave it on the channel. But if there's no question, subscribe, hit the notification bell. And just like I said, we have talked about only one correlation today. I have told you how many we have. Look at them here. We have the US dollar index. We have just finished discussing that. We have the gold. We have oil. We have the stock. We have Euro JPY. We have the bonds and so many others. We have a lot to do on this channel. I have always been saying this. Don't be in a rush to leave. Stay on this channel and then get this additional information for your own good. Thank you. My name is Kofi, your admin for this channel. I'll see you in my next video.